Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
AAA, there is a childhood book that I think a lot of people could benefit from the moral of the story. It goes something like, there's this emperor, this powerful ruler, and he's just obsessed with clothes. And he's obsessed with the beauty of the clothes and the fabric of the clothes and looking pristine and showing off how wealthy he is. And of course, when someone's obsessed with something, there's people who are ready to take advantage of that. So the story goes, there's two swindlers, and they decide that they are going to market to this emperor the most beautiful suit of clothes that has ever existed. And they build their brand and their reputation. They go in and they get in to see, and they say, emperors around the world are wearing this fine suit of clothing, and there's no one that has anything like what we're about to show you. And if you want to be the absolute best, you need this. And they build in this suit of clothes, and it's a fabrication. It's not real. There's nothing there. And the emperor looks at all of his people in the room, and no one wants to talk up against the emperor, right? So he says, how does this suit of clothes look? And they bow down and they say, yes, sir, that's beautiful. That's beautiful. And so he says, I need a parade so he can, right? So he can show off this new suit of clothes. And they set up a parade, and he goes out into the streets, and he's wearing this beautiful suit of clothing that these two swindlers made for him. And it's not until a child who's standing on the sidelines of the parade that says, Daddy, he's not wearing any clothes. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew Daniel Agemy. Welcome to our 4th of July show, Let Freedom Ring, Investing by Contract in and for Retirement. Wow, Daniel, that's a great story. I think that's a great kickoff to what we're doing today. Hey, we got a parade, and a lot of parades for 4th of July, right? And you know what I also think about, Daniel, when you're saying that story, is the concept of how many times today people's definition, right? A lot of people use words, but then their definitions we have to understand, right? And those swindlers, they were using these words that this was a beautiful set of clothes, and they got the king to buy into their definition, but he in the end had the wool pull over his eyes, no pun intended. But the Let Freedom Ring, Investing by Contract, and that's a great story of what I think you're going to tie that to the opposite of investing in contract, right? Which is hope. Hope is not a retirement.
There's all types of ways you can relate this. One is when people are so focused on one thing, they're so focused on the storyline, having the best suit of clothes, they can be easily taken advantage of. When the crowd is saying you need to have the best thing, you need to get into these things, the marketing companies, the Vanguards and the S&Ps of the world can force people into things they wouldn't normally do, but because we're so obsessed with markets going up, or we're so obsessed with listening to Jim Cramer or these financial pundits that are pumping stocks, we can be taken advantage of, right?
Yeah.
And it's the retirement illusion, basically.
Right.
Of this works no matter what. And people are getting taken advantage of, just like this emperor, but nobody wants to stand up and say, there's no clothes here. There's nothing backing that up. It's a bubble. It's just air. It's social investing, or it's momentum investing, and that's all it is. If the momentum goes away, you're wearing nothing, right?
Right. Exactly. And that's why we're coming today with this show, Let Freedom Ring, right? Because freedom in retirement equals stresslessness. And that is, what we want to provide for people. And we believe that an educated retiree is a happy and stress-free retiree. And so when we're looking at this, it's important to be able to understand retirees' greatest fear is running out of money before they run out of life. And so many times that happens. By the time they realize they're going to run out, it's too late to do anything about it. And many times why that happens is because they're listening to the swindlers. Well, it can be very well-meaning people, very nice people. But in the end, for them and their situation is not the best advice to take, just like with this king. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic, Let Freedom Ring, investing by contract. This father and son team come to you to be able to help you to be able to understand, be educated, make smart decisions, and help you know what you don't know. Today, we have a special report that we put together for you, be able to help educate you further. This is going to be a very helpful report to help you recognize part of what we're talking about today, investing by contract. And that's when we're talking about bonds versus bond funds. Bonds are a form of contracts. Bond funds are not. There's no contracts with them, and people don't realize that. It's just a fund that owns contracts. So anyway, we'd love to put this in your hand. Bonds versus bond funds. You can have it for free by calling us at 800-725-7616 for your free copy. No obligation. Again, that phone number is 800-725-7616. Call now for that. You listen to Financial Strategies. Happy 4th of July weekend. Let the freedom ring, investing by contract in retirement. Wow, Daniel, why is investing, what's the significance of investing by contracts?
Well, when we talk about investing, right, there's hope investing and there's investing by contract, and there can be a big difference. If we talk about independence and we talk about being financially independent, what gives you financial independence? There's a lot of different people that would say different things, but part of that would have to be there's some confidence there, right? And what gives you confidence? If you're walking down the street, you're a very wealthy person, and it could be your brother-in-law, it could be your neighbor. Your neighbor comes over and says to you, I'd like to borrow $50,000 from you. I'm going to be putting a pool in the back, and I need $50,000. I'm starting a business and I need $50,000. You could write them a check and hope that they pay you back, right? They could tell you that they'll give you $100,000 back once the business starts off or you get shares in the company. But are you going to feel a little bit better if you guys write up a contract that says exactly when your neighbor needs to pay you back, what the parameters are for paying that back, what you're going to get in return, if it's interest, if it's shares, or it's whatever, and then you go down to the notary public and you get it signed and you file it with the attorneys and you have your attorneys review it before you fork over that 50 grand, right? That's what we're talking about here. That can give you a lot more independence, right? A lot more confidence in that retirement. And then if you had a bank actually do due diligence on this person to make sure they're credit worthy and get that into the contract, that's a whole nother thing that you could add on top of that, right? So that's the difference between just willy-nilly investing for hope, and investing by a contract, where one is there's some notion that maybe you'll get something at some point in time, or historically it has happened, compared to you have a contract backing up what is promised and what you're going to get for your capital investment. And to me, that would be financial independence, where you know what you're going to get. So you have enough income, you have enough payments that you can support the lifestyle that you want to have for all of time, for your lifetime.
Yeah.
That's financial independence. Not you have $1 million in the bank, you've got $10 million in the bank, because you could spend all that down if it's not reoccurring income that you have a contract backing up, right?
Right. Exactly. Typically, the kind of investing by contract is going to give you dividends and interest. So you're getting money besides the actual principal. And that is the key is using interest and dividends rather than principal. Whereas typically people build their money in their 401ks and then they think of like a bank, well, I'm going to withdraw it when I need it. And that is engineering income, which could actually end up cannibalizing their assets. And that is not, the place to be. So it's a crazy thing when it comes to that. I like the idea when we're comparing the two, hope versus contracts, right? Where hope is like the idea of planting a garden and praying for rain. Now, I'm a man of faith. I believe in prayer. I've seen things happen, right? But when you pray for rain, you never know if God is going to answer your prayer that it's for rain when somebody down the road is praying that it won't rain, right? So right? But you don't know, right? But if you have a sprinkler system for your garden, you know it's going to work from that sense. Sure, there's a possibility it breaks, right? But generally speaking, it's going to work, right? I mean, let's test it. So that's a great thing, is that you can have confidence in what's going to happen as opposed to just hoping. How many times you say to somebody, when are you going to retire or whatever, and they'll say, well, I hope I can retire. I'm hoping. Right. And that, to me, hope is not a retirement plan, right? Contracts can be a retirement plan. You listen to Financial Strategies with Andrew Daniel Agemy, this father and son team, coming to you this 4th of July weekend to say happy 4th of July, happy Independence Day. We'd like you to declare financial independence and let freedom ring by investing by contract and doing things a little bit different than what most people are, so that you can be sure to be able to have more than enough income to live the rest of your life. Well, we'd like to give you a video book today that has 3 different tracks of animated cartoons, animated education on various things like Social Security, required minimum distributions, how to invest for income, these kinds of things. We'd love to put this in your hand for free. Ask for it by name, video book, by calling us at 800-725-7616. 800-725-7616, or hit us on our website, agemy.com, the 2 words Agemy, spell our last name of Agemy, and you can just request video book on there, and we'll contact you for getting that to at the proper place. 800-725-7616, and we'll be right back after this.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you, so you can enjoy your retirement. It's a little more income stability.
I'm in.
That's 2 out of 3.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
Investing by contract is a great way to use a perspective. Is when somebody buys a house and they take out a mortgage. It's a contract that the bank has with the people. They've looked at their credit rating. They've looked at their situation. They say, okay, we're going to give you this money. We're going to loan you this money, and with these parameters on it. And so it's a contract, and that contract, with that, the bank knows when they're going to get their money back, how much they're going to make, when they're going to get it by. Whereas the people, they know that if the people don't pay it, well, they're going to ruin the people's credit and they're going to take their equity. So the people who are borrowing the money from the bank understand that that's the thing that gets paid first, is the mortgage. I mean, if they have to go without food, they'll go without food in order to pay the mortgage so they have a roof over their head, because the contract says they have to do that. And then the bank is very happy because they know they're going to get their money one way or another. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about Let Freedom Ring. And AAA, how do contracts have to do with letting freedom ring on this 4th of July weekend?
Well, that's great, Daniel. In that analogy that I just used in that example of the mortgage, right? If the people, if the investors, the retirees, pre-retirees, issue contracts to companies that the companies have to pay them the way that they were paying the bank when they were younger, then they can count on that. And they can understand that the bank, that the companies that are paying them, they don't want their credit rating to be messed up. It could be the kiss of death to the company. So they're going to do everything they can to pay the investor back, the retiree back, and give them the interest they need every month. So when a retiree invests his money in contracts, they know what they're going to be getting every month or every year, and they can then depend upon where their paycheck is going to come from, as opposed to having withdraw from their, $500 million, $2 million, $5 million every year. So,
yeah, so it gives a lot of confidence, right? Gives a lot of confidence, not having to worry about what's happening in the world, not having to worry about what's happening in the stock markets. We have so many clients that come in and they will say things like, is the stock market doing well? Or, there's a lot of uncertainty out there. How's the portfolio going to do with the uncertainty? And we have to take a couple steps back and look at the bond and bond-like investments or investing by contract. So these are certain things. These are maybe like a government bond, right? Where you lend the government your $100,000. They say, I'm going to pay you $5,000 every single year. And at the end of the 5 years, I'll give you your $100,000 back. It's that simple.
Yeah, that's beautiful. Yeah.
Your $100,000 could go up to $105,000 over that period of time. It doesn't matter. You're getting $100 back. You could sell it for $105, or it could go down to 98 in that 5-year period of time. It doesn't matter. You're still collecting $5,000 each year. And at the end of 5 years, the government is going to give you your $100,000 back. They're going to give you it back. The U.S. government got downgraded, right, by I think it was Moody's recently. It doesn't matter. They should be quadruple A rated because they have a money printer. It would be like if you had a money printer. You could write your name, right? You could write your name on any piece of paper, and people would take that as money. You could write, I am King Bucks, right? And hand those out. That would be called counterfeiting, and you go to jail for that. But the government is allowed to do that. And so they will give you your $100,000 back. Those are contract types investing. So other things, right? Other contract investments, insurance companies do it, right? They'll write up a contract and they'll give you a lifetime income. They'll look at your age, they'll look at your mortality, and they will, and sometimes these are very good incomes. And if you don't necessarily care about having an inheritance, you want to make sure you never run out of money, that could work for a lot of retirees. Other things are corporate bonds. Corporate bonds do a great job with this. You can get some amazing income from corporations where they do the same thing. They give you a contract and you know how much you're going to get paid each year. And at the end of the time frame, you get your money back. Banks do it with CDs. There's government agencies that back mortgages and things like that. Can get contracts from. So there's a few different things that are direct contract investments where you have a contract with an entity and you know exactly how much you're going to get paid, when you're going to get paid, what happens if they renege on that payment, and when you get your money back.
Oh, wow. Yeah, with all those choices, you mean because a stock doesn't have those things, right? Stock price goes up, stock price goes down, stock price could go down to zero. Could, right? Stock price could go up a lot, but with a contract, you've got guarantees in place. It's a beautiful thing. If you're just tuned in, you're listening to Financial Strategies with Andrew Daniel Agemy this 4th of July weekend. Happy 4th of July. Let freedom ring by investing by contract. And we have a book we'd love to put in your hand to be able to help you with this and be able to educate you further. Simple, easy read book. My friend Michael Eastham, CPA, PFS, has put together this book that I think he's done a masterful job. He makes it very common. It's called Common Sense Income Strategies, right? Very easy to read, makes sense how these things work so that and no, don't try this at home, but helps you to understand that there's still a lot more than what this book is. It's not a detailed do-it-yourselfer kind of book, but it is being able to educate you, understand how it works. Love to put that in your hand for free by calling us at 800-725-7616. Next 5 first-time callers at 800-725-7616 for your free copy of Common Sense Income Strategies. Call now. You're listening to Financial Strategies. Let freedom ring, investing by contract, because people don't know what people don't know. Daniel, you were talking about how insurance companies issue contracts and talking about annuities, especially. Yeah, there's life insurance contracts, but in this case, we're talking about annuities. And I just want to say to you and our listening audience, if you have an annuity, and if it's 2 years old or older, especially, you owe yourself to do a second opinion on that, to get that analyzed, because the Federal Reserve has issued a gift to people with interest rates being as high as it is. Annuities, older annuities that are 2 years old or older, are not anywhere near as profitable for people today, usually, as the new ones are. And the new ones will go into the future at a better rate. So you need to be able to take a look to analyze what you have. Is it worth keeping, or is it worth changing, or whatever the case may be? And, if you would like us to help you with, that's fine, but you owe yourself a second opinion on your annuities if you have that. Daniel, there was you were also talking about, right, that bonds and how they work. And you were mentioning, I forget what the denomination was on the bond, but let's just say it was a $10,000 bond that went up to, let's say, $11,000. And like you said, you could sell that bond at that point. And that's the beautiful thing about having a manager, right? Instead of just buying the bond and holding it to maturity, you buy a bond, hold it to maturity as a backup. But if the manager says, hey, we can make 10% by selling this $10,000 bond for $11,000, and we can buy a $10,000 bond for $9,000 or something, right? That's a great thing, right?
Well, that is one of the underestimated things about investing by contract. So with the contract, it's mathematically certain growth and income. So if it goes up from your par, so your $10,000 bonds go up to 11, you've collected $500 a year for as many years as you owned it, and now you could sell it for 11,000. So you made 10% growth, and you collected 5% each year for as many years as you owned it. Now, if you have that active manager like you're talking about, and you buy it at $9,000, so you buy 10 bonds at $9,000. How much are you going to get paid when the government buys it back from you?
$10,000.
$10,000, right? So now
and you only paid $9,000. That's wonderful,
right? You made $1,000. That was mathematically certain because it's a contract that says we have to pay you $10,000 when these things mature. And so the cool thing with investing by income, one of the cool things is you can get built-in growth, mathematically certain.
Right.
By buying these things under par. And that can be a tax-efficient way of investing, or that can just be a way where you can protect yourself from inflation. You can spend all the income and you can get the growth, again, mathematically certain growth, by buying these things under par. So it's pretty cool what is available by contract. Now, the other thing by investing by contract that you don't get by stock market investing is there's less volatility. Because if you have a 5-year bond, you put $100,000, you gave it to the government. We'll use the government as an example. You gave it to the government. They're going to pay you back in 5 years. How much volatility do you think is going to be in there? Maybe it comes down a little bit, but what does it matter if it comes down a little bit? Because you're going to get your money back in 5 years. Even if you lend it to a corporation, you lend it to somebody like ConocoPhillips, right? This is a strong company. You lend them your money. You lend it to them for 6 years. How much volatility is that going to have? There's not going to be a 50% drawdown. Something extreme would have to happen for a ConocoPhillips, that bond, not stock, to have that kind of drawdown. And for them to go bankrupt is like the probabilities are off the chart of that happening because they have more cash on their balance sheet right now than they have debt.
Right. So with our clients, they're getting somewhere between 5 to 10% average per year, every year, between interest and dividends and growth and whatnot. And, and that's at a lesser risk. That's at a lesser beta than what the stock market is. And if the S&P 500, would you say, I think you say the S&P 500 is like a beta of 1. Is that right?
S&P is beta of 1, yes.
Okay. So the lower the number, the less risk. The higher the number, the more risk, right? than the S&P 500. So, in this kind of portfolio, where would you say the beta would be? It would be far less than 1, right?
Yeah, the beta is typically, if you are in all direct contracts, the beta is probably going to be 25, so a quarter of market risk.
Right.
If you mix that with some of the indirect contracts, maybe you get up to half a market risk. So the market has a 10% correction, you have a 5% correction. But it depends on how much direct and indirect contracts you have. Because the indirect contracts, which we'll get into next, they have a little bit more volatility. Right. They are still far less risky than market, and the income that they produce is more certain than market, but they are more volatile than the direct contracts because there's very little risk. You just have default risk when you're looking at these contracts.
Okay, cool. So we need to take a break. So join us after break if you just popped in, because we're going to talk the difference between contracts, direct contracts and indirect contracts. And you're listening to Financial Strategies. It's Daniel Agemy, this father-son team coming to you today on this 4th of July weekend to say, let freedom ring. Invest by contract for retirement. And with that, we love to be able to offer to you. So many times people say, can I retire? When can I retire? I hope that I can retire. This is a question that plagues people. We'd like to be able to help you answer that question. Book yourself on our website for an intro call, agemy.com, agemy.com, or call us, 800-725-7616, 725-7616 to allow us help you answer the question, can I retire? When can I retire? Call now, and we'll be right back after this.
This is Financial Strategies with Andrew and Daniel Agemy.
So there's this thing called the prudent man rule. The prudent man rule is known, the prudent investor rule. It's a legal standard requiring fiduciaries, trustees, investment managers to manage assets in the same care, skill, and diligence that a prudent person would exercise in managing their own affairs. This means avoiding speculative investments and focusing on long-term health of the investment portfolio. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about Let Freedom Ring and AAA Prudent Man Standards. I think that goes back to definitions, though, because if you manage it in the way that you would manage your own affairs, and you are a speculator, then does that meet the prudent man standards?
Well, it's a prudent person would exercise in managing their own affairs. So we have to go back to what's the definition of prudent, right? And really it goes, prudent is, avoiding speculative investments and focusing on the long-term health of the portfolio. So there is some variability in that, right? But it's clear, what we're always talking about is that people need to understand what kind of investor are they? Are they a speculator or they're an investor? And today, a lot of people, in my perspective, are speculators, and they don't realize that they're speculators. They think they're investors, but to be an investor, you need to get paid. And many times, speculation, it could pay you, but you may not get paid. Whereas by investing by contract, letting freedom ring, investing by contract for retirement, you're always getting paid.
That sounds pretty nice. Always getting paid.
Always getting paid, right? I mean, that's the thing. When people retire, they don't need $1 million, $2 million, 500,000, whatever the number is, $5 million. They need a check to replace the check that they're no longer getting from their employer or their business. Social Security puts in a little bit about that, but to most people, Social Security, it might be 40% of what they need in retirement. So they need a check. And to always get that paycheck coming in from contractually, that's a beautiful thing. And that's to our clients listening in, you're given a report. The report and the summary of your investments. On the back page of that report, there's a chart, there's a report of how you're getting paid every month. It shows that if you have one of those in front of you, the green shows what has actually come in, the blue shows what's expected to come in over the next year. And whereas people who are not investing by contract don't have that option, they don't have that piece, that report, or if they do, it's certainly not as substantial as what your report is showing.
So Triple A, you say all the time on this show, it's not, you don't need $1 million to retire. It's not $1 million, it's not $2 million. And I think that investing by direct contract speaks to that, because you kind of do need $1 million. You need, it depends on your lifestyle. You need a certain amount of money. But what you're saying is it's not so important what that amount of money is. It's what it can create in income for you. So, for example, we had a client come in the other day, and they have an annuity, because these are one of these things that are direct contract investing. And they put $500,000 into the annuity. It was worth like $650 or something about 5 years later. It's not an amazing return, but what it could do for him was it produced $50,000 of income. So that would be a 10% payout on the original investment. That is good, right? And that's where it's going. If you can live off $50,000, or you have other income that's generating $50,000, there's an example where $500,000 is enough to get you $50,000. Now, that doesn't work for everyone, but this is why it's specific to each individual person's need. If you don't want volatility, you want a contract, you want lifetime income, and that's a way you could get $50,000 of income. Well, that's a pretty interesting thing for that person, right? They have other investments that are doing other things, but it's all personalized. Again, some of those other types of contract investing are, we talked about the annuities, the bonds, you've got preferred stocks, you've got government agencies. You can do things like real estate investing. Now, that's not a real estate investment trust, that you own a rental property, you own a building, you own a home that you're renting out, and you have a contract with your tenant, right? So people understand those types of investing too. Then we go into the indirect contracts, right? Where these are someone holds the contract, but it's not it's not you. So that could be like a business development company, where the business development company owns a contract with whoever they're lending the money to, and then you get income from that, right? That could be a CLO fund, that could be real estate investment trusts, that could be royalty and streaming companies. And am I missing anything there with the indirect contract? I guess technically that could be a bond fund. We stay away from those, because why would you get an indirect contract when you could have a direct contract? But if you wanted to invest in maybe international bonds, for example, you're not going to go buy you're not going to go buy individual countries' bonds unless you have a lot of money, which if you do, good for you, and you could buy those individually, but typically you would do that through a fund. Right. Exactly. Good stuff. You're listening to Financial Strategies with Andrew Daniel Agemy. Today's topic is Let Freedom Ring, investing by contract for retirement. This father-son team coming to you because people don't know what people don't know. And we'd love to be able to give you this white paper. We have a white paper today, a report that we put together for the show called the Case for Fixed Income. So ask for it by name, fixed income. This is investing by contract. Fixed income is investment contract.
there's the stock market, the fixed income market, the real estate market, and all different markets. You need a buyer, you need a seller. What's it worth? Well, it's worth what somebody's willing to pay for it, but it acts differently than the stock market, just like the real estate market, used car market act differently than the stock market, et cetera. So you can have it for free by calling 800-725-7616, 800-725-7616 for your free copy for fixed income. Call now. You listen to Financial Strategies, let freedom ring, investing by contract. People don't know because people don't know. So investment by contract, direct contracts, bonds, insurance contracts. Oh, one of the things I wanted to say by that, Daniel, there's companies out there that tout, well, you should never buy an annuity. And I think that's really interesting, right? Because every kind of everything that is for sale out there is for sale because there's a use for it, right? When you're talking about contracts and such, there's a reason for it. The question is, can you match up the reason properly, right? And for some people, annuities fit the bill. For others, they don't. And that's why the customized approach is so important, right? The boutique approach, fixing the burger your way, exactly the right temperature, all the different fixings that you want, as opposed to just going to McDonald's. So annuities have their place. The question is, what is the place for you? These companies that say, oh, you should never buy an annuity, I find it really interesting because there's a small dividend that they produce for their clients, but typically their fee is taking pretty much what the dividend is. So the dividend's not doing any good. And then they say things like, oh, you got to have at least $500,000. And when you drop below $500,000 because you're cannibalizing your assets, they kick you out and they say, go find somebody else. Crazy what some of the things going on out there.
Yeah, and you do need to be careful with direct contracts because the contract is only as good as the person who is guaranteeing that contract. So even with annuities, you need to be very, very careful what annuity company you're talking about. So you need to be careful with buying corporate bonds. You need to be very careful which corporations you lend your money to. You can't just say, well, this is an annuity, so it's good, or this is a corporate bond, so it's good. So you're absolutely right. You do need to be careful with the credit worthiness of whoever that is and the details of the contract. Now, most people don't want to get involved with checking out the contracts and checking out the covenants that are involved with those contracts. Mm-hmm. So what do? Mm-hmm. They buy it in a fund, or they say that it's bad, or they don't understand it, or whatever it is. Right. But those are the types of things that we like, where everyone's not in it. It's not a momentum strategy. Why do we like that? Well, when there's things that are not being understood, but we understand, or we're very good at, it's our forte, then what does that do? Whenever there's stuff that's not understood, for the people who understand it, it presents opportunities, right? It presents mispricing. And so that's why there is very good deals in these types of contracts we've been talking about, because either funds buy it and they don't care about price, so they dump things because they have to, which creates buying opportunities, or they buy things that they shouldn't, which presents buying opportunities or selling opportunities. And so there's mispriced, which allows you to get the closest thing there is to a free lunch, right? Because when there's mispriced deals, that's where alpha comes in. You've been talking about beta, that's where alpha comes in, where you get better than the benchmark with a lower risk.
Mm-hmm. Oh, cool. Very cool. Yeah. Treasure hunting, right, Daniel? That's what you like to treasure hunt. You like to find $10,000 bonds for $9,000, $8,000, $7,000, right? Mispriced stuff, right? Yeah. That we jump on because we know what we're looking for, right? And that is so huge. And, like I say to so many of our clients, Daniel, is that, if you see things being bought or sold in your portfolios, we're doing that for one of two reasons: either to protect your money from losing money, or to make you more money. And we don't get paid on the trades. We get paid for just managing money overall and watching it for people, because they don't have the time to watch it themselves. And that is or expertise.
It's difficult reading all the contracts, right? It takes a lot of time understanding how these contracts work. But there's reward. There is reward in that.
Right, right. And I like what you said about the insurance companies. Just don't take an insurance company because not all insurance companies are created equal. And you can't even trust the ratings on insurance companies or bonds, right? Because in 2006, 2007, there were a lot of bonds saying, oh, these are AAA bonds, the best bonds out there. Then 2008, 2009, after a crash, they're called junk bonds, triple D, or even if they're rated anymore. How does that happen? It's the fox in the hen house, right? Where the rating companies get paid by the companies they rate. That is for the birds. And that's why I like that we've hired a company to be able to do that for us, that we can trust them because we pay them, as well as doing our own research and things like how we check stuff before we buy. And then even after we buy, we still check stuff to make sure it's good, right? Just like during COVID, we owned Hilton hotels. We sold Hilton hotels when COVID happened because we didn't know what was going to happen. It was a defensive move, but we got out while the getting was good, but we checked it and we recheck stuff. And, I can't say that, most people are getting that kind of customized professional management, but you're listening to Financial Strategies. Let freedom ring on this 4th of July weekend. Happy 4th of July weekend. Hope you're having a good one. And invest by contract for retirement as opposed to hope, because hope is not a retirement plan. Today's show is dedicated to helping people be able to retire and stay retired. And we have a something we'd like to give you today. It's a kind of fun book. It's a video book. There's 3 different channels on this where it has animated screen and story of how to invest by contract, how to make sure that you're planning for your required minimum distributions properly, or how Roth IRAs work, those kinds of different things. We love to put this in your book in your hand for free by calling us at 800-725-7616. Be one of the first next 5 first-time callers at 800-725-7616. Ask for it by name, video book. Call now, and we'll be right back after this. The biggest mistake retirees make is not switching from the growth model to the income model. A good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
This is Financial Strategies with Andrew and Daniel Agemy.
So John and Mary, clients of ours, they were after us, kind of like to talk about, I need to log on to the internet to Schwab to see my accounts and all, blah, 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 blah. And they were having the hardest time in the world. And when I sat down with them, I said, okay, help me understand what's going on here, because, there's some disconnect. And they said, well, we want to see what's happening to our portfolio every day. I said, but that's what happened is you're not in the stock market anymore. It's not going to change every day the way that it did previous. You don't have to worry. Calm down. The stress levels can now go down. And when I explained that to them again thoroughly in that fashion, they were very happy and very content to be able to rest and be stress-free. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. We're talking about Let Freedom Ring, investing by contract on this 4th of July weekend. And AAA, we got a lot of amazing freedoms here in this country. It's such a blessing to live in such a wonderful country. And even with all the chaos and things that are happening, it's amazing that we have the choice that we can listen to this show, or we can choose the investments that we want. We're trying to bring education to the listeners so that they can make smart decisions. But it's amazing that we have the freedom that we can actually pick what we want to do with our investment funds in our retirement.
Isn't that wonderful? Yeah, we can choose what clothes we want to wear. We can choose what kind of cars we want to drive.
Visible clothes, or we want to
wear. Right. But, that's what I say. When I think about it, the poorest American is far better off than most people in this world. Like one person said to me, at least in America, you have a dumpster not far away, right? Some countries don't have dumpsters that people can dive into, right? And it goes far down than that, right? Even the poorest American has so much more.
Yeah.
Right. And so we have and I know, there's a lot of people that, are not happy with this country, right? And this country is not what this country used to be. It's still, in my mind, the greatest country on earth. And I'm so glad to be a part of this. And I'm so glad that we can celebrate our dependence from other nations. And as you know, Daniel, this is our, your mother and I's 43rd anniversary, right? When we celebrated our dependence upon one another, not our independence, but on our dependence upon one another. And happy to be married to that wonderful woman for so many years. So, Kathy, happy anniversary. So with that, we're talking about Lynn Freedom Ring, investing by contract for retirement, because when you're in retirement, you want to make sure that you have enough money to be able to live the rest of your life and have more than enough money to live the rest of your life, income, without having to worry about it, right? To take the stress away. Who wants to worry about running out of money?
Right. And that goes back to your story where the worry has been built into people. We call that the 401k brain, where you're used to logging in your 401k and seeing if it's up, seeing if it's down, and worrying. Now you're retired. Right. You're thinking about retirement. Forget about it. Forget about it. Enjoy being on the beach. Don't log into the portfolio. Enjoy being on your cruise. Enjoy spending time. You don't need to worry about it. Now, if you want to log in and you want to look at those sweet, sweet dividends coming into your account every day or every 15 days or every month, that's pretty fun. I enjoy doing that myself, logging in there and seeing all the money that's coming into your account, because that's what happens when you invest by these contracts and direct contracts. They pay you something, which means you can log in and you can just see money flowing into your account every single month. That's pretty cool. But you don't need to worry about ups and downs because you're investing by contract. So there's Daniel, not the volatility, number one. And number two, if there is some volatility, you got us, if you're a client, in the background, reinvesting that stuff, taking advantage of that volatility, but just enjoy the sweet moolah coming into the portfolio, right?
Right. But even if you're in our listening audience and you're not a client, that's fine, right? We just encourage you to look at a different way of investing, one that you can depend upon, one that you don't have to worry about, that can help you to be stress-free in your retirement. What do you know, Daniel? I'm constantly telling our clients to spend money. Right. Because, like the sign in the travel agency that says, if you think you can't afford to fly first class, your kids will. Right. And so I'd rather have my clients spend their money during their lifetime. I'd rather have you spending your time surfing the internet for the classic cars or muscle cars that you want to buy, or the kitchens you want to remodel, or houses you want to buy, as opposed to looking at your portfolio. I want you to just understand, just like you did when you were working, that you got that paycheck coming in every month and you don't have to worry. Beautiful thing. Well, you listen to Financial Strategies with Andrew Daniel Agemy. Today's topic is Let Freedom Ring. Happy 4th of July, everybody. Investing by contract for retirement. Today, we're getting ready to wrap up the show. But before we do, we'd love to give you a book that will help educate you further. Our friend, Mike Esom, CPA, or PFS, has written this book, Common Sense Income Strategies. And common sense is not so common anymore. But Mike gets down into the basics of how to invest by contract and how it can be prudent, following the prudent man rule, to help you not just have what you need, but also grow your portfolio the old-fashioned way through dividends and interest and compounding. Love to put this book in your hand for free by calling us at 800-725-7616. Right now, call us at 800-725-7616 for your free copy. First 5 first-time callers, 800-725-7616. Common Sense Income Investing. You're listening to Financial Strategies. This father-son team coming at you today to help you know what you don't know. Let freedom ring. Daniel, as we get ready to close up the show today, it's been another great show. Appreciate having you here, and it's a lot of fun doing this show with you. And I'm excited about people being educated, help, and stress being taken out of people's lives, and them becoming more stressless. What do you think?
Yeah, Triple. I was talking to a client the other day, and it goes to the importance and the benefits of moving from that 401k brain, that hope, that logging in and hoping your account is higher so you can sell some assets so that you can have the lifestyle you want, to what we've been talking about, these contracts, right? Contract investing. And I'm talking to the client who has been a client for a few years. And each time we talk, they're saying, can we get more aggressive? Can we get more aggressive? Can we move into these things? But recently, they both retired. And she says to me, I used to know how much I could spend when I went to work because I knew what I made and I knew I could spend X amount. And I knew if I got a bonus, I could buy a new car, or I could do this, or I could do that, because I knew how much money was coming in. And now I don't really care about leaving an inheritance. I just want to know how much I can spend. And it was like an aha moment. I said, that's what we've been talking about for all these years.
Right.
It's the income. And we were able to make some changes to get even more income because we cut out that 401k type stuff and changed over to complete income. And now it gives you that confidence, just like when you go to work and you know how much you can spend because you know how you can earn. It's that same concept. It's intuitive, but we've been taught over all these years to get rid of the intuitiveness and look at this weird 401k brain stuff where we hope it goes up and we hope it goes up and we hope momentum keeps working. Instead of saying, I earn $75,000 a year, I can spend that $75,000 a year. And that's when we're talking about these contracts where you have a contract, you have lower volatility, and you have more certainty of returns because these contracts and indirect contracts are geared to pay you. And right on the reports, it tells you, right on your statement, it tells you how much money it's going to pay you each year, which is a beautiful thing. And it takes so much stress out of retirement.
Yeah, that's what I love about those summaries that we give our clients, Daniel. Not only does it list all the different assets that they hold with us and whatnot, but, those bottom line numbers at the bottom, right? 2 of them, right? The chickens on the one side and the eggs on the other side, right? Their assets on the one side and what kind of income they're getting from it, that income summary kind of information. And, folks, what we're been talking about here is the concept of, when you're in retirement, and you can invest for hope, which, you have to eat when you're in retirement, right? So if you invest for hope, it's like you're buying roosters. And, you could, every time you have to eat, you have to kill a rooster. And that's okay, but you may run out of roosters depending what happens. But if you buy chickens and you only eat the eggs, the chickens are the contracts. And then you only eat the eggs, the dividends and interest that's coming from those, and you'll always eat. You'll never run out of eggs. It's a beautiful concept of investing by contract rather than just hoping you're going to get there. And then, right, Daniel, what happens if we add an active manager to it?
And then if you have the active manager, right, you still have your contracts, you still have your chickens, but when they're getting huge, when they're getting fat. And with euphoria, people think they're going to get bigger and fatter. Well, when you're investing by contract, you already know what the contract says. So when you get to the peak end of the contract, you can sell those chickens, collect the money, and hold it on the sidelines. So when it's not euphoric and they're all skinny chickens, you can buy 3 of those chickens with the same money you sold 1 chicken for, which means you get 3 times the eggs, which is the income, which means you can go on a spending spree because you're not spending your money, you're spending the money your investments are generating from you. It's the beautiful thing about investing by contract.
Right, exactly. All right. That's beautiful. You've been listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic's been Let Freedom Ring, Investing by contract for retirement. Happy 4th of July weekend, everybody. Hope you're having a great time. And we're so happy to be Americans and have our independence from other nations. And we want you to declare financial independence for retirement by investing by contract rather than just hope. And today, as we finish up today and depart, a couple things we want to leave you with is the concept of, number one, if you have an annuity, the Federal Reserve has issued basically a gift to people with annuities, and you owe it to yourself to get a second opinion on that annuity. The second thing is, many people want to know, how am I set up? Am I set up for contract? Maybe am I getting eggs already from my investments? Well, we'll be glad to take a second look at your portfolio, give you a second opinion. I call it a financial MRI. When we look at your portfolio and see if there's financially cancerous cells in your portfolio, if you need to do some chemotherapy or do some surgery or whatever to your finances, or whatever the case may be, we'll tell you our perspective, see if we see any red flags. We're more than welcome. You're more than welcome to call upon us as a radio show listener for a conversation. And we'd love to be able to have an intro call with you to be able to answer any of those questions, whether it's a second opinion, whether it's an annuity, or whether it's, something else. Yeah. Call us at 800-725-7616 to schedule your intro call with me. Quick 15-minute call where we can look at what you want to look at, talk about what you want to talk about. 800-725-7616. Call now. Until next time, listen, we want you to be able to remember, if you want your retirement to be stress-free, invest for the I, the income, more than the G, growth. Till next time, be well.